Good morning and good afternoon, everyone. Welcome to our session, Quantify Credit Impacts from Volatile Global Dynamics. In the next 30 minutes or so, we'll discuss innovative approaches to identify risk factors and also scenario testing to measure macroeconomic impacts on your credit portfolio. My name is Katriona Ho. I lead the market development of credit analytics in APAC. With us today, we have Michelle Cheong, the head of business and content strategy in APAC. Firstly, Michelle will walk us through the various ways where credit research and insights from S&P Global Ratings could support us to detect risk factors and signals under this volatile macroeconomic environment. Thereafter, I will illustrate the importance of scenario testing on portfolio monitoring by leveraging our macroeconomic scenario models and how we can quantify the range of impacts on a sizable portfolio from foreseeable volatile market conditions. Before we dive right into the session, just a very quick mentioning on some housekeeping. You will be able to submit your questions via the widget down below, and we'll answer them in the Q&A session at the end. In case we didn't have enough time to go through all your questions, we will reach out and address them offline. Without further ado, I'll pass the time to Michelle. Take it away.
Thank you, Katrina. Hi, I'm Michelle Cheong. I lead data strategy, data governance, and business strategy for credit solutions in Asia Pacific. Prior to this, I headed global product development for Ratings Express, which is the enterprise platform delivery of credit ratings data. In the past few years, macro factors such as inflation, pandemic, supply chain issues, geopolitics, and lately the gas disruptions in Europe have been dominating the news headlines. We are all not short of getting lots of timely updates from news. We just need to switch on the TV. The challenge here is knowing when these news headlines are actually going to translate into systemic credit risk trends, and whether we have to take action to de-risk our own portfolios. Now, to illustrate this challenge, let's consider an analogy between lightning and news articles. Conventional wisdom tells us that lightning is often seen as an early warning indicator of thunderstorms and rains that are coming, and on average, it makes sense to take cover. But if you live in this place of Singapore, there's an average of 171 lightning days every year. It is not practical to de-risk every time there's a lightning flash in the country, as many of them will not affect your immediate area. So in risk management language, it's a lot of false positives. So therefore, it is useful to also, in parallel, when we're looking at news, look at confirming signals that indeed rainfall is coming. So similarly, a risk manager that has a flood of breaking news to deal with on a daily basis could perhaps also benefit from some way to assess how important are these blips on your news radar. That is to confirm the materiality of these early warning signals in respect to your own portfolio risks. An investor that is using text mining algorithms and natural language processing on news articles to derive alpha signals could also potentially benefit from a systemic way to increase the confidence level or importance of these alpha signals. So we want to break the problem down into 3 steps in this presentation. The first step is how do we sieve out the trends from the noise in the news? That is, when does a news report theme become important enough to potentially affect systemic credit risk in general? The second step is to find another way to measure the strengthening or weakening of these qualitative trends. Because the reporting of hot news topics in the news websites, if we observe casually, have a fair amount of churn. So if we try to derive a sentiment indicator from recent news articles alone, you may see temporary surges in these news articles, which fade away fairly quickly. Now, even though the underlying risk trends are still persisting in the background, right? Because the news has already switched to another breaking news topic. Finally, what is in it for us? How do we objectively assess how these macro trends affect our own portfolios? Next slide, please. So let's try to think about the first 2 steps, which is how to sieve out trends from noise. And secondly, how do we measure the strengthening or weakening of qualitative trends? Now, to address these first 2 steps, we want to consider deriving quantitative indicators using text analysis. Now, here we look and focus on abstracts in credit ratings research reports. Now, ratings research is interesting as a supplement for news articles for several reasons. Now, first, ratings articles are often written or sometimes written to address questions that are frequently raised by the investor community who are responding and reacting to these news. So there's a certain level of filtering and digesting these news headlines with a specific credit risk angle that is embedded in ratings articles. This also means that text analysis of ratings articles, whilst not always as timely as breaking news that happen within the hour can help to confirm the importance of individual news headlines. Now, secondly, the second attribute which makes ratings research particularly interesting is that ratings articles are published in a fixed format. Now, what this means is that within the article, if not all the sections are themselves indicative and flagging risk trends, we can simply extract away those which inform credit risk versus those which are general descriptions of the company's own general description. And in fact, we've databased this in a way that you can simply extract the articles without even using a text parser. This allows you to actually filter out similar sections in the article, form aggregates on text-related indicators across different articles, across geographies and industries, and then analyze ripple effects. Now, in this graph here, we are going to use a very simple illustration of text analysis. We counted how many abstracts from S&P Global Ratings Research in Asia Pacific region contained keywords that many of us would have read in the news over the past few years. We focus our text analysis on abstracts for the time being versus outlook and base case scenario, which could also be informative. Now, when we looked at outlook and base case scenario sections in ratings research, they could also contain other keywords in the ratings criteria and key writer factors, which are routinely included in news articles and in these articles, even though they don't always signal any trends. And more importantly, abstracts are executive summaries. It distills the gist of the whole article, and inclusion of any keywords in the abstracts is likely to flag trends that the credit analyst is trying to make sure the investor community actually pays attention to from a credit risk point of view. So in this chart here, we've bucketed keywords in a couple of themes that are probably common and in your radar by now. War, which will include war, physical conflict, war, conventional war, trade wars and other types of conflicts. We also looked at pandemic and COVID keywords and used that as a bucket, inflation, supply chain, and also climate change. So we took a 3-month moving average of the number of articles citing these key theme words to smooth out the effects of analysts having different levels of timeliness in responding to the same news headline, whilst being sensitive enough to flag changes that is rise and falls in these trend lines. So if you use like 6 to 12 month averages, for example, you'll be looking at the persistent trend and you may not be picking up on trends fast enough. So let's look at the results here. The first line in red, which is dotted, where we grouped conflict in the different forms, which is war, trade war, and other conflicts. You can see that actually it's been casting a shadow on Asia Pacific since the first date we started tabulating our data in January 2018 in the study. However, in the recent months, it became more prominent as a risk factor just before and definitely after the Russian invasion of Ukraine. You can see that in that section on the right, which is highlighted in yellow, that the red line has indeed started trending up very significantly. In fact, in a relative sense, this theme, as of May 2022, the theme has overtaken in importance the line in blue, which references the COVID-19 pandemic in May, the COVID-19 pandemic. The COVID-19 pandemic, you can see, actually started to rise in importance from a credit risk point of view, starting early 2020, after the first outbreak in late 2019. So if you look at just the break in trend in COVID, you can see that it's actually been rising fairly rapidly in the early part of year 2020. Now, from a trend analysis point of view, while the risk remains high in recent months, and the number of articles citing it, you can see that it has definitely started to come down in year 2021 onwards. And now COVID and war has taken over as the most frequently mentioned risk theme affecting Asia. The lighter red lines that you see below the blue and the dotted red line are flagging inflation and supply chain issues. Now you can also see that these have also started picking up in the yellow zone in the chart. They became important in the early part in year 2020 after the first COVID spike, but definitely has resurged significantly starting around February 2022, just around the Ukraine conflict beginning. So related to these disruptions is also inflation due to supply chain shortages. It was important in 2021 and definitely more so in 2022. Finally, whilst climate change was less frequently mentioned and less dominant compared to the other credit risk drivers, it continues to stay on radar throughout the entire period from 2018 to 2022. Next slide, please. Now we can see how these factors could have coincided with some of the ratings changes over the same period. There was a strong downgrade momentum in year 2022 globally in APAC during the initial COVID waves. You can see in this chart here, we've charted the percentage of ratings upgrades minus the percentage of ratings downgrades and defaults. So if you see the bars below the x-axis, it indicates there's more downgrades and upgrades. And if it's above the x-axis, there's more upgrades and downgrades. So there's a fair amount of downgrade momentum in year 2020. As the COVID situation improved and the economy reopened, you did see a fair amount of upgrade momentum in year 2021. And then again in the earlier part of year 2022, you are seeing downgrades outpacing upgrades as shown in the credit pro database. Next slide, please. Looking at the more granular level at the articles, do you actually see any important themes bubbling up in our risk radar over the past few years? So I'm just going to look a little bit underneath the hood, beyond just the few themes we've identified earlier. And in Asia, now there's the keywords are flagged outside Asia actually is slightly different. So that also lends to interesting cross-country and cross-region analysis of the same word clouds. But in APAC, we can see that there are a couple of themes that are being flagged, even in the abstracts. First is the effect of SACP, standalone credit risk versus the role of government support, especially in China. The second is asset and capital, really how much can you fund your funding ability. The third, not surprisingly, is China. And the fourth really pertains very specifically to how much you're able to service your debt obligations relative to your using your earnings and cash. Next slide, please. So where are we trending? And how resilient, given that there is supply chain issues as well as macro shocks and also inflation plus interest rate hikes in the horizon, it's also interesting to see how resilient we are going into this series of shocks. And here we just take a quick look at the distribution of credit ratings of entities on a global basis. On a typical year, we would see a nice bell-shaped curve of ratings distributions with a peak at BBB. Now, what this means is that usually in a normal time, there are very few high-risk entities, which is at B and CCC plus and below, and there's also very few on a relative basis low-risk entities within the rated universe. Now, but in the last few months, we did find that this was not the case, and indeed this is a red flag. Now, you are here in this distribution of what is typically a bell-shaped curve. You can see that there are two peaks to this distribution. In fact, the number of issuers circled in yellow here, that are rated single B plus to single B minus, actually exceeds those of the other ratings categories. So we're entering into season of rate hikes and supply chain disruptions when a number of entities have fairly fragile credit risk fundamentals. And in fact, if you look at the articles that have been coming through as key topics from our ratings colleagues, you can also see that there's a fair amount of focus in the CCC issuers rising in number as well. Next slide, please. Now let's drill down one level below the credit rating into what is really driving a lot of the downgrades and what is driving the vulnerability in credit risk fundamentals. Now we've extracted this from the scores and factors database, which database the drivers of credit risks and credit ratings. And specifically, it actually standardizes some of these metrics across geographies and industries. In this chart, we basically looked at the financial risk profile across geographies and industries. It looks at basically we included it in the appendix. It looks at the ability for present and future cash flows to actually fund the debt obligations for entities. It is standardized on a scale of 1 to 6 across different geographies and industries, with 1 being the lowest, being the best financial risk profile, minimal, and 6 being highly leveraged, which is the worst. Now we can see that clearly, in addition to the many entities that are rated single B plus or single B minus, there's a fairly worrying skew towards the worst risk categories of 5 and 6. In fact, these two, if you sum those two red bars circled in yellow here, they amount to about half the entities, which is having high leverage relative to earnings. So the combination of rate hikes, which could increase the borrowing costs as firms have to maybe have to roll over some of their debt and borrow in the future, plus supply chain disruptions which shrink the bottom line, could put some of these entities at a compromised position from avoiding debt default perspective. Now, in this backdrop, being able to stress test your portfolio's resilience to interest rate hikes and supply chain disruptions also become very key to risk management. And so right now, I'm going to pass it to my colleague, Katriona Ho, to walk through macro scenario stress tests. Over to you, Katriona.
Thank you, Michelle. So I guess switching gear, we understand that from a credit risk management standpoint, we often have less visibility in the unrated space. And how do we monitor our portfolio that consists of both public and private companies, rated and unrated names, and potentially across a wide range of industries and of various sizes? As Michelle mentioned, of all those key factors, top of mind, such as inflationary pressures, rising interest rates, war and supply chain disruption, could have significant impact to our credit exposures. But more precisely, how can we tell which are the ones that matters the most to our region and exposures? There are various ways that we could stress test our portfolio to measure and derive such impact. Scenario analyses give a full representation of possible future situation, which helps us to understand the dynamic of change in a more holistic way. It is important to consider a set of factors and on the interaction between different risk factors. We should also take into consideration the likelihood of various scenarios, the different degree of severity that represents these foreseeable upcoming critical events, so that in this evolving global dynamics, we can conduct an effective ongoing monitoring in a robust way. So before the testing and defining the scenarios that we should use to attempt to capture the possible impact, we should also consider the approach and the objectives where we could formulate strategies and management actions thereafter. Typically, we measure the downside risk and we could try to capture the riskiest, largest exposure. From scenario testing, the dynamics of change offers us insights, such as which risky part of our exposure is more likely to require our additional attention when these emerging risks arise. Some are just inherently risky, and may not necessarily deviate under different scenarios. That helps us to shape our strategy and decision-making process. Needless to say, a range of the outcome could help us to quantify the impact and allows us to communicate such downside risks. So I've listed a few of them on this page. As an example, we took a relatively sizable portfolio of 12,000 companies in Japan of various sizes and across all sectors. In reality, it is likely that we have counterparties that's from various countries and regions as well, which is why it is important to have a robust quantitative models that is applicable to measure the vast majority of our exposures. To illustrate how macroeconomic scenarios can impact our portfolio, we leveraged our fundamental-based probability of default model, which also comes with the complementary function of macroeconomic scenario testing feature to provide comparable results across our portfolio and under vigorous testing in an effective way. As you can see in the spider chart, or you call radar chart on the right, we measure the average probability of defaults by different sectors. We also illustrated the results from various scenarios, such as the starting point at 2021 last quarter, indicated in red, and a sample baseline scenario that represent 2022 condition in orange, and a more extreme isolation scenarios in gray, of which both the baseline and isolation scenarios are distress scenarios, but with different degree of severity under the Russian-Ukraine war impact. You can see the most significant industry here on display is the hotel and gaming industry at about 2 o'clock on the chart. It has the highest PD values amongst the portfolio. We also have utilities where its PD values range from 2.4 as of Q4 last year, and then to around 3.3 to 3.7% in the distress scenarios. With a robust set of data, we can derive insightful information and nuances. For example, entities that focused on consumer durable goods, such as appliances, home necessities, jewelries, home and office furnishing, etc. We saw that there was an increase of PD from last year to end of 2022 in this potential distress condition. But hypothetically, even when it gets more extreme towards the end of this year, the default level doesn't worsen much correspondingly. Let's say if we're able to zoom in into a subset of smaller size companies, such as SMEs. Here we are considering entities with a total revenue of no more than 25 million US, and with approximately half of the total portfolio there. Just at a very quick glance on the pattern of the average PD across different industries, the distribution is very different. What we observe is that as the riskiest sector on our portfolio in the previous chart, I showed a quick preview on the very top right here, versus the SME portion subset here and the main spider chart. Hotel and gaming industry is no longer the most acute of all, and it actually remains around 4% to 5%. We can see the utility sectors has significantly higher PDs from around 8.7 to 9.7 than in the level that we saw in the previous chart, where PD levels previously ranged from 3.3% to around 3.7%. It was not apparent before, but once we strip out the pharmaceuticals company that are at large scale, we detected that the SMEs pharmaceutical companies have a significantly riskier credit profile. And again, it was not necessarily due to distress from economics factors. Here, I would like to quickly highlight that the scenarios that we used here for illustration purposes is provided by our economics and country risk consulting division. What I have here on this page is only for reference, and I won't go into the detail of the assumptions of the scenario, But the focus here is not on the scenario itself, because formulating these macroeconomic scenarios would take another entire session. The key here is that whether you have a set of in-house scenarios or leveraging intelligence, such as inputs from our ECR consulting business, there are tools and models that is robust and can help you to capture the potential impact under volatile conditions. This is an ongoing monitoring process, as we all know that we cannot look at these evolving conditions in a snapshot. 3 months ago, as compared to 3 months later, could be a very different picture. Should you have any question on the scenario itself, we'll ensure that we can address them by our ECR team via separate engagement rather than in this Q&A session. So I guess this is a really great segue for us to take some questions. And the first question that I have from the audience here, is for you, Michelle. As you mentioned, the timing of credit research is lagged as compared to, let's say, news articles. Would you elaborate a little bit more on how the credit insights serve as an early warning signal for us?
Thank you, Katrina. So in the earlier discussion, we talked about using credit ratings, text mining, to really to filter out and determine whether the particular credit risk trend on a news headline could be flagging a significant credit risk trend. Now, one way we can some of our clients could use it is to consider, first of all, let's start off with whether you qualitatively read something on news headline, or perhaps if you have any natural text mining processing that reads through news articles and bubbles up these themes, right? You can then group similar keywords and quickly run any trend analysis or word clouds on the ratings research over the last 1 month or up to the last 90 days, just to see if they confirm that these are actually actually going to affect your credit risk portfolio. So there could be news headlines which are interesting, but not yet seen as a significant risk factor, which perhaps you can just park it and keep it in view for the time being. But definitely for those where there is appearing a news headline, and as you track the credit risk abstracts over time, that you see it also bubbling up in the in the credit ratings articles, then these are definitely risk areas that you keep on your radar. Now, by having the ability to run text mining and text processing on these, it really just allows you to run a large number of articles so that you don't have to just focus what is in your immediate geographic area and what you can read, have time to read, but also track through other articles across regions, across related industries, for example, and outside your country. And so that makes the exercise a lot more scalable.
Thank you, Michelle. Another one for you here. The audience is interested to know, when we leverage, say, keywords from these credit research to help us detect signals, how do we differentiate signals between, let's say, credit improvements versus credit deterioration? Would you say it is more skewed towards risk factors rather than supportive factors?
I think this is an interesting question, because there would be certain tax, right? Especially when you look at, it depends on which section you look at. So if you look at sections such as your business risk, financial risk, and leverage sections in the full analysis article, they would definitely be mentioning some of these so-called, what they call key credit factors or key drivers that are in the ratings criteria, regardless of whether they are material or not. Now, there are several approaches to do this. Firstly, you can look at specific parts of the rating article that especially pertains towards forward-looking credit risk trends. These can be abstracts, as I mentioned here. And then secondly, you can also take a look at outlooks, and then you can then look at, the second part is to actually look at the deltas, look at the changes in the frequency. So let's say that if, hypothetically, let's say if you saw that debt to EBITDA, on a normal detrended basis in the past would always be mentioned about 40 times in the 1 month sample, in the 3 month sample, but suddenly you saw that the number of mentions itself has doubled, right? break in trend could actually inform that this is indeed a dominant risk factor, dominating as a risk factor. And secondly, I think this is tax analysis is only the first part of credit analysis. We've gone also in the presentation talked about really going at the metrics themselves, looking at the scores and factors database to see whether whether it is also confirming the same concern. So if we saw debt to EBITDA and inflation and showing up as a trend on the one side, we can see that indeed it is the fundamentals that are also weak from a credit risk point of view when we look at the entity analysis, entity credit factors, and aggregate that up. So in that sense, you can always multiple confirmations even within information contained in the same article.
Got it. I also have another question here regarding our underlying database, I guess. Do we actually have information on rated entities that turns unrated when we conduct these kind of analysis?
This is interesting. I think sometimes when a rated entity really turns highly speculative grade, I mean, one action that could happen is they just turn into NR rather than defaulting. Interestingly, when we looked at the time series trends, there is no specific spike in the percentage of entities that turn NR. But in fact, we did see, if you just looked purely as from the grade of BBB plus to BBB, double B plus to double B minus, turning into B plus to B minus and below. And then also from B plus to B minus to triple C plus and below, right? In this kind of downgrades, we did see a significant shift in two periods. The first is the period of 2020, when we saw a lot of downgrades from in the double B category and also the single B category that coincides with COVID. And the second wave that we saw is actually in March 2022, just after the Ukraine war. Again, we saw spikes in downgrades relative to upgrades in credit ratings in the double B and the single B category.
Understood. Yeah. I guess we also have this question. Maybe I could take this one. So the audience is asking us, how do we quantify portfolio impacts under distress scenarios with, say, inflation and rising interest rate? I guess let me flip to this slide just for everybody's information. As I mentioned before, it is important that we consider a set of factors and their correlations in the scenario testing analysis. So during our testing, because we're considering a potential future event, let's say the war scenarios that we're talking about, which also has the impact to inflation and rising interest rate. As you can understand that the geopolitical tension reduces GDP growth and boosts inflation significantly. There are also policy trade-offs facing by central banks around the world, resulting in rising interest rates. Ideally, to capture the imminent impact, such as from inflation and interest rates holistically, we really need to consider how it affects our sets of factors. So, for example, in our credit analytics model and under the macroeconomics scenario models analysis, we consider macro factors such as real GDP growth, unemployment rates, Dow Jones Market Index, House Price Index, mortgage rates, and prime rates. We'll also take into account like some historical economic shocks, such as the condition from global financial crisis in the past, to help us understand how a portfolio would be impacted. So, if you would like to find out more, feel free to reach out to us. And I really appreciate everybody's time, and I thank everyone for joining our session today. I think this is the end of this session. And if we receive any other questions that we haven't really been able to address today, for example, some of those ECR consulting scenarios related questions, we will reach out and address them with you offline. Thank you very much for joining our events. Have a great day.
Thank you.